All right. Well, thank you everyone for joining. I think we're in for a terrific presentation this evening. We're fortunate to have Eve Benton, the 2023 Managing Broker of the Year, who's going to spend some time with us and, really let us know kind of what's going on in real estate, share her experience on how we can avoid some critical mistakes. My name is Jeff Blackman. I am not Eve. I'm not the presenter. You'll see her shortly. But I did want to just welcome everyone in. Let's go ahead and get started. So first, we're going to give a little bit of a commercial. So I introduce myself. I'm Jeff Blackman. I'm the Chief Lending Officer with the Mortgage Store, and we're very happy to sponsor this event with Eve. So the Mortgage Store, we're a mortgage brokerage, and that means we represent about 50 lenders. And because of that, we're typically able to find the lowest, the lowest rate that's in the market, as well as the best terms. We've been around for 23 years, and we're licensed both here in Illinois and in Florida. All right, so here's the reason you guys came. Eve Benton, she is the designated managing broker with Exit Strategy Realty. In that role, she actually leads I think it's over 260 licensed brokers and agents, both in the city and in the suburbs. She brings over 15 years as a real estate broker. And she's also a licensing instructor. So not only does she know what it means to be a great agent and a great broker, but she teaches other people, coming into the industry what the best practices are. She's a member of the $1 Million Club. That's really a group of folks who are able to sell more than $1 million worth of property in a given month. And she's done that several times, several months. And what I think is really important and why you should listen to her is she's the Chicago Association of Realtors 2023 Broker of the Year. Now, anyone who's been listening or paying attention to the real estate markets would know that 2023 was a very difficult time. Interest rates were high. There weren't a lot of properties on the market. But in that environment, Eve's peers, because she was selected and voted by her peers, the 17,000 members of the Chicago Association of Realtors looked around in all of that mess and said, you know what, we think Eve is doing the best. And I think that's an endorsement. It's great to get an endorsement from your peers. But the other thing I think you should think about is these are also Eve's competitors. So what they were really saying is she's doing it best and she's doing it better than me. And so I think that says a lot.
Mistake number 3, not getting pre-approved. I touched on that a little bit. Unless you're paying with cash, you are using someone else's money. You want to get pre-approved. You may feel like I have great credit, I have great income, but what you have not taken into account is maybe your debt to income ratio, the type of loan product that is most beneficial to you. So you are kind of spinning your wheels until you know that the amount and the type of loan product that you have. So that's a huge mistake that people make. Not too many people, but some people do.
Yeah, if I could jump in, I just want to share some mortgage myths because at this point, Eve will typically send someone in my direction, and a lot of times they have different questions. So why don't you go ahead and put in the chat whether you think these myths are true or false. So you need 20% down.
LaTanya can't answer.
All right. No one's taking a guess there?
Is that true or false?
Okay. So 20% down is false. We actually have programs where you can put 0% down. We actually have other programs where you're given money. And so you get a grant that goes towards your down payment and sometimes can even cover your some of your closing costs. What the 20% down that people think about relates to is it actually has to do with something called private mortgage insurance. So if you put less than 20% down, then you have to buy private mortgage insurance, which really just protects the lender in case you go into default on your loan. Your credit score must be perfect to get a mortgage. What are some thoughts on that? That one's also false. Credit scores range from 350 all the way up to 8 850. I've seen scores all across that range, and we actually have programs in certain situations. You can go as low as 500 with a credit score and still get a home. You won't get the best rate at that point, but you will get a home. And what we can do is work on improving your score so that you can refinance your home, which means pay off your high interest rate mortgage with a low interest rate mortgage once your credit improves, and actually decrease your payment. Um, Another one, you can't get a mortgage if you have debt. Not true. Eve talked a little bit about your debt to income ratio. So it depends on how much debt you have related to how much income you have. And if the ratios are correct, then you're perfectly fine to get a mortgage. Pre-qualification and pre-approval are the same. That's false. Eve talked about getting postcards from realtors wanting to list her homes. A lot of times people will get postcards that say, "You've been pre-qualified for a loan. Call us to see if you're approved." I mean, if you read the fine print when it says, "Call us to see if you're approved," that should tell you it's not the same as a pre-approval. And it basically says, "We think maybe you're qualified," but it doesn't really have anything standing behind it. And then all lenders offer the same mortgage rates. What do people think of that? So lenders do not offer the same mortgage rates. If they did, I wouldn't need to work with 50 different lenders. I work with different lenders because all of them have sort of their own business. And you can think about some of the large national banks. For example, if they had a lot of loans in Illinois last month, they may want more loans in Florida next month. So what they'll do is they'll slowly raise the interest rates in Illinois to discourage people from getting loans from them. And then at the same time, they might lower them in Florida. And what I'm able to do is look across all the lenders that I work with and understand who has the best rate in Illinois today. I saw a question from Krupa. What's approximately the best interest rate that's going in the market? As we get a little bit further into the presentation, you'll see why that's sort of an impossible question to answer without knowing, what are you looking to buy? Are you buying a condo? Are you buying a home? Are you buying a 4-unit building? What's your income? How much are you going to be able to put down? So all of those factors go into determining what your interest rate is. So that's why it really makes sense to have a conversation with a lender and don't just, Google best interest rates because it'll give you an average and it won't give you the detail that you need to understand if it really applies to you. And then here's the last one. You should always choose the lender with the lowest interest rate. How many people think that's true or false? Excuse me, 1 minute. Sorry about that. Sorry about that. I hope that wasn't too loud. But there are many times where the lender with the lowest rate actually has the highest cost. And so you need to really take a look at, what your intent is, how much cash you have, how you want to use that cash, and that'll determine the best program that you get into. So it may have a slightly higher interest rate, sometimes as little as an eighth of a percentage point, but it could have significantly lower costs, which means you're able to, buy more furniture when you move in because you have that cash available. All right, so I'm just going to very quickly take you through an example of what lenders look at when they underwrite a loan. And I want you to think of the CIA. I find when I say that to people, they tend to not forget. So CIA, the C stands for credit, the I stands for income, and the A stands for assets. So your credit includes both your credit score and your credit history. And that credit history is made up of how much credit you have outstanding. So what do you have on credit cards, student loans, car notes, and then your payment over time on each of those. Income is pretty straightforward. It's what you make, and lenders look for it to be stable. They look for it to be predictable, and they try to figure out if it's likely to continue for the next 3 years. Um, and then the last part is the assets, and those need to be liquid and seasoned. And so, what does that mean? Sounds like a recipe there or something. But liquid basically means either it's cash today or something that you can convert to cash pretty quickly. So it could be a savings certificate, it could be stocks or other investments that you have that are easy to convert to cash. Seasoned means that you've had it for at least 60 months in your bank account, because banks don't want to see a
60?
large.
How long?
I'm sorry. Yeah, that was a mistake. Thank you. It's 60 days, not 60 months. 60 days, so 2 months. And because banks don't want to see a lot of cash put into your account at the last minute unless there's an explanation behind it. So you can have a large deposit as long as you can explain where it came from. So, like I said, if you sell stock or if you take money out of your retirement account to use for the down payment, that's perfectly fine. But what they don't want to see is, money that people have had in their mattress, or, where they don't really know where it's coming from. And the reason is they want to make sure that you didn't go out and borrow additional money to now pay for this. And so now you're going to be paying your mortgage and for this new debt that they don't know anything about.
I had a cousin where that was an obstacle for her. She really had mattress money. She felt like it was easier for her to just tuck it away and not spend it.
Yeah, and
It needs to be seasoned. Yeah.
no, I've been surprised at how many people I run into that are in situations like that. And sometimes it's well, I was planning to take it to the bank, or I was changing banks or something, and they have a lot of cash in their pocket, and then we really need to be able to explain that. So credit scores, as I said before, they range from 300 to 850. I've seen everything. And one of the things that we have in our firm, so we have a team that actually works on helping you improve your credit score. That's no cost. And it's actually, I mean, we do the real legitimate improvement. We don't do what a lot of credit repair companies do, which is tell you to just dispute everything. So credit decisions can be tricky. I mean, we talked through a few myths. I just want to go through a couple things, a couple more examples that I think are counterintuitive. So opening a new credit card, does that lower your score? How many people think this is true? How many think it's false? Well, the truth of the matter is it depends. And actually, a client that Eve and I are working with, um, her credit score was not where she wanted it to be to take advantage of a specific program that we wanted her to use. And our recommendation, so I sent it to my credit team, and the recommendation was open a new credit card. And she actually did that. And in about a week, her score actually improved about 50 points, believe it or not. And that was pretty dramatic. And so a lot of times people think, well, don't open a new credit card, don't make any moves, and that's why I go back to what Eve said earlier. The moment you're thinking of buying a home, you should sit down with a lender. I hope it's me, but sit down with someone, tell them what your plans are, and they can help you walk through how to help you get the best loan for your situation. Right. Eve talked about this a little bit, but paying a past due account, will that increase your score? So go ahead and put your thoughts in the chat. So again, I apologize, but this is another trick question. So again, it depends. If it's something that's very recent, it more than likely will increase your score. But think about, a loan that's 4 years old, a credit card that maybe you haven't paid in 4 years. The impact that that has on your credit score right now is very low because it happened 4 years in the past. If you make a payment on it today, what you've done is you've created a current account that now has 48 months of late payments. over that 4 years. And so, in certain situations, doing the right thing, taking care of a past due account, will actually lower your score. So again, talk with someone before before making any moves.
The other thing that people that I've talked to, and they were just like, I need to get set up payment arrangements for my student loans. And I'm like, stop, don't move, talk to the loan officer before you set that up.
Yes, because we want to make sure you set up the right type of payment, right? Whether it's income based or another plan. And so, how about this? Getting a raise, does that improve your credit score? True or false? So this one is actually false. Your credit score has nothing to do with your income. It's really driven by the amount of credit you have and how you handle that credit. And this is the last one. Disputing a valid charge on your credit report will increase your score. So if you have a charge and you dispute it, what will be the impact of that? Okay, I appreciate Debbie putting all the answers out there. So disputing a valid charge will not increase your score. Um, I talk about this because I run into so many people who, do the right thing, right? They look at their credit report. They say, hey, I think I can improve this. So they go to a credit repair company. The credit repair company says, they'll usually tell them two things. They'll say, okay, dispute everything. That's the first thing they say. Then they'll say, but don't do it all at once. The reason they say that is when you dispute a charge, it actually gets pulled out of your credit score. So if there's a negative account and you pull that out, your credit score will actually jump up. But what's going to happen is the next month, when the company that has that credit says, no, this is a valid charge, it's going to go back on your credit score and your score will come back down. But that's the reason that they tell you to wait to dispute something else. Because what happens in that second month when that one's coming down, they tell you to dispute a new one, which raises your score up. And so if you're just looking at your score, what you're seeing is 2 months of score improvement. But that's not really what's happening. You're just switching one for another. And typically they'll have you paying a monthly fee for their services, and all they're doing is collecting that fee while your accounts go in and out. And then when you run out of accounts to dispute, that's when they sort of disappear. They don't return your calls, and they'll keep charging your credit card for their services until you cut it off. But disputing a charge, unless it's incorrect, will not make a permanent change to your credit score. And the other thing is lenders know this, so no lender will actually approve your loan if you have a dispute on any account. They'll say, okay, well, if it's valid, we'll wait for that to get resolved. Or they'll say, you can remove the dispute, and then we'll look at your real score, and we'll, then we'll approve the loan. All right, so credit repair do's and don'ts. I talked a little bit about, disputing legitimate accounts. It really doesn't make sense. If there are true mistakes on your credit report, you should dispute them. And you can actually dispute all of them at once. Don't listen to the credit repair companies that say, oh, if you dispute too many, you'll get put on a list where they'll ignore you. They can't do that. They're required by law to look at all of your accounts. So if it's legitimate, if it's an account that is clearly a mistake, go ahead and dispute it, and that will positively affect your score. Disputing an account that really is true is ineffective, and it's actually illegal. And as I said, lenders won't approve your loan with a dispute on your credit report. All right, so what should you do? What you should do is if you work with a legitimate credit repair person, they will give you a specific target score. So if you come to me and your credit score is 620, my team will look at your reports, come up with a recommendation, and they will say, if you follow our recommendation, in 30 days, your new score will be 653. I mean, they will be that specific. They won't just say, hey, it's going to go up. They'll say it will go up to this level if you take these steps. And then also ask for a specific time frame for improvement. The example I just gave was 30 days. The client that I told you, Eve and I have been working with, it was 1 week. Said, take these steps, open a new credit card, put a specific balance on it, call them, ask for a statement, before the end of the month, get a statement right away. We were able to take that to the credit bureaus, and they were able to improve her score. And it was about 10 days in total. But what she had to do took less than a week to do. So any legitimate credit improvement person will give you a specific target score from the actions that they're telling you to take, and they'll give you a specific time frame. Okay, any questions on that? So, Eve, I actually have a delay on my window, so if you see a question come in, could you read it off? So, any questions on credit? It's like when I sit down and talk with people, I get a lot of questions on that. Okay. Um, and another benefit of working with us is we have a tool that's called Vita, and it really is what we call a financial fitness tool. So it helps you set goals. So first of all, you figure out sort of what you're able to afford. Then it helps you set budgets and goals to get there. That can include saving. It also can include actions to improve your credit score. And so it takes you through a series of questions, first of all, figuring out kind of where you are in the buying process. And then also, again, asking about your goals. We've, both Eve and I have talked a lot about what are your goals? Because, even if someone's looking for, if there are two people and they're both looking for 3 bedrooms, 2 baths in the same suburbs, if they have different goals in terms of how long they want to be there, in terms of what they're going to use their home for, it may make sense for one person and it may not make sense for another. And just like the home may not make sense, the mortgage you get may not make sense depending on what your goals are. So it's really important that you sit down with someone who will listen to you and ask you about what your needs and your goals are. This tool also helps you figure out when you're mortgage ready. So it gives you different stars. In this example, they've earned 3 out of 4 stars. And so they still need to make some progress on their credit score to get it where they want to be for the program that they're looking at. And so we'll give you free access to this tool. We do this with anyone who works with us. And since you're sitting on this webinar, we'll give you free access to this as well. All right, so question I get, how much can I afford? So is anyone on the webinar currently either pre-qualified or pre-approved? If so, just type in there, say pre-approved, pre-qualified, put it in the chat so we can understand. And if you want, you can even share how much you've been pre-approved for. I will tell you one thing, you may have been pre-approved for a loan amount, but in reality, you're actually pre-approved for a monthly payment. And then based on that monthly payment, we sort of give you an estimate of what that translates into for a loan based on current interest rates, based on property taxes, based on insurance costs, property insurance for your home. All of those really get rolled into what your monthly payment is. So most loan programs allow you to have up to 50% of your monthly income available for all debts. And what that includes are credit cards, student loans, car payments, personal loans, really anything that you signed for. Anytime someone gave you money and you signed something, that counts as your monthly debt. But the way you calculate your monthly income is to take a look at your hourly rate, multiply it by the number of hours you work each week, multiply that by 52 weeks in a year, and that gives you a total for the year. Then you divide it by 12. So if we go back to our anxiety guy from the beginning, let's say he makes $30 an hour and works 40 hours a week. That adds up to $62,400 in a given year. And then he would take that amount divided by 12, and that would be his monthly income. And so you'd go through the same process if there are two people on the loan, so if two people, one person had 30,000 of income and another had 32,400 for a total of 62,400 for the household, you'd figure this out the same way. And if you just had a straight salary at 62,400, you'd figure it out like that. And so for him, his debt to income ratio needs to be 50% or lower, and that's 2,600. Now I'm going to walk through just an example to see if he can afford this house. So he's figured out his monthly income, and he wants to know if he can buy a house for $225,000. So let's say he puts 3% down, which he's able to do in many first-time homebuyer programs. That's 6,750, and so that means his mortgage will be the difference. The purchase price is 225,000. You subtract out the down payment, and the rest goes into your mortgage. So his mortgage is going to be $218,250. So with a monthly payment, if you assume an interest rate of 5.99%, which is a reasonable rate for a lot of people now, his monthly payment would be $1,307. Since he didn't put 20% down, he has to pay mortgage insurance. And that's abbreviated PMI for private mortgage insurance. And in this example, that's $135 per month. So his total mortgage payment is $1,442. So good news, that's less than his $2,600 that we said it needs to be. But unfortunately, we're not done yet. We need to think about something called escrows. So if anyone has ever heard of an escrow, really all that is money that you pay to your lender that they set aside to pay for two things. One is taxes and the other is insurance. And the reason that they pay those is when you buy a home, you get what's called a mortgage. And that mortgage basically says if you don't make the payments, the lender can take your home back from you. There are really only two things that can get in their way. One is if your house burns down, there's nothing for them to take back. So they want to make sure that you pay your property insurance. And the way that they do that is they look at what your total property insurance cost for the year is, they divide it by 12, and then they ask you to pay that each month. It goes into an escrow. When your homeowner's insurance is due, they write a check to the insurance company. You don't have to worry about that. And so in this example, it's $1,200 or $100 a month. The same thing is true with property taxes. If you don't pay your property taxes, the county can come in and take your home. And then your lender wouldn't be able to take it back if you didn't make your payments. So they collect your property taxes. They do it 1 month at a time so that when your taxes are due, they write the check to the county. And the great thing about that is if they don't send it, they're actually on the hook for that. You're not on the hook. So they're actually responsible for that. So in this case, their annual escrow is $4,800. You divide that by 12 and it's $400 a month. So right now their total monthly payment is $1,842. And you might hear the term PITI, that stands for principal and interest, which comes from your mortgage, and then taxes and insurance. And so that's an important number to pay attention to. And so again, more good news. We're still below $2,600. So this looks pretty good for our guy who's nervous. The last thing you need to do is take a look at your existing debt. And so this person had a car payment of $475. They had a Capital One credit card where their minimum payment was $52 a month. They had another Chase credit card with a payment of $35 a month. And they had a student loan where they were paying $103 a month. So all of that non-mortgage debt adds up to $665. So what we need to do is take a look at your mortgage debt and your non-mortgage debt, add it together, and that comes up with $2,507, and his monthly income was $5,200. So his debt to income ratio, which is a term you'll hear, is 48%. So this is less than 50%, which means he's in good shape. So I know that was a lot. There are a lot of numbers on the page. Sometimes people are intimidated by the numbers, but there's really no need to be intimidated. It's pretty straightforward. And, I've given you all the information, so you can actually calculate this yourself at home. So you can just calculate what your monthly income is, look at your current existing debt and those payments, and the difference between that and half of your monthly income is what you can afford to spend on a new home. But Eve and I actually are very willing to offer you a free, no obligation consultation. And so you can, pull out your phone and use the QR code, or you can type um, into the website. Eve, actually, why don't you put that in the chat?
Sure.
So first time home buyers webinars. So there's an S in there. Mortgage store.com/book. And so what you'll get is a 30-minute meeting with Eve and Jeff. I'm Jeff. Um, so Eve will help put together a home buyer profile based on your wants, your needs, things like that. I'll help put together a mortgage readiness assessment to help you figure out where you are and how quickly you can buy a home and how much you can afford. And then we'll also give you free access to our Vita financial fitness tool that I talked about. And it's all at no cost and no obligation.